Your real estate strategy lives or dies by one classification, passive or active. And real estate professional status could be the deciding factor for which side your losses fall on, allowing you to actually offset your income and lower your taxes. Hi, I'm Sherry Ayland, and I help clients pay zero taxes using real estate strategies from my Zero Tax Blueprint. To see if the Zero Tax Blueprint can work for you, click the link in the description. If you've been watching my recent videos on bonus depreciation, cost segregation, material participation, and passive versus non-passive income, then today's video is the missing puzzle piece that makes all of those strategies actually work together in a powerful way. Here's the hard truth. Bonus depreciation and cost segregation by themselves don't save you taxes. What saves you taxes is whether the IRS allows the losses from those to offset your other income. And that decision comes down to one thing. Are your real estate losses passive or non-passive? That's where real estate professional status, or REPS, comes in. Now, why REPS even exists? Under the default IRS rules, rental real estate is passive, no matter how involved you feel you are. And passive losses generally cannot offset W-2 income, business income, or other active earned income. Before 1986, that wasn't the case. Rental losses could offset everything. Then Congress shut it down. And in 1994, after heavy lobbying from the real estate industry, Congress added REPS to the tax code, not as a loophole, but as an intentional exception for people who actually work in real estate. Now, what does REPS actually do? REPS does one thing and one thing only. It allows you to overcome the automatic presumption that your rental activities are passive. That's it. It does not automatically make your losses deductible, and it does not eliminate the need for material participation. Think of REPS as unlocking the door, but you still have to walk through it correctly. There are two tests to qualify for REPS. To qualify for REPS in a given tax year, one spouse must meet both of these tests. This is where material participation comes in. First, you must spend more than 750 hours during the year in real property trades or businesses. And second, more than half of all the working time you spend during the year must be in those real property trades or businesses. And this is critical. Those hours must be in qualifying real property activities, not just real estate adjacent work. So let's first talk about what real property consists of. There are four categories here: land, buildings, inherently permanent structures, and other inherently permanent structures. Land includes water and airspace superadjacent to the land, as well as natural products and deposits that are unsevered from the land. A building would be anything enclosed with walls and a roof, if permanently affixed to land. Houses, apartments, hotels and motels, stadiums and arenas, shopping malls, office buildings, factories, warehouses, barns are all some examples. An inherently permanent structure just refers to something that's meant to stay in place for a very long time that is securely attached to land. Other inherently permanent structures might include parking facilities, bridges, tunnels, railroad tracks, pipelines, or storage silos or oil and gas tanks. With that in mind, let's talk about the 11 qualifying real property trades or businesses that the IRS recognizes. Number one is development. These would be activities involved in improving raw or underutilized land for real estate. Examples would be entitling land, zoning, planning subdivisions, and preparing land for construction. Number two is redevelopment. Improving or repositioning existing properties to increase value or change use. Examples here would be renovating an old apartment complex or converting warehouses to lofts. Number three is construction, the physical building of real property structures. Example, building homes, apartments, office buildings, or commercial facilities. Reconstruction, number four, is the major rebuilding of existing structures beyond normal repairs. For example, structural rebuilds after fire damage or gutting renovations. Number five is acquisition. This would be time spent locating, analyzing, negotiating, and purchasing real estate. Examples would be property searches, underwriting deals, due diligence, or closings. Number six is conversion. changing a property's use from one category to another. Examples would be turning a personal residence into a rental or office space into residential units. Number 7 is rental. So owning or renting real property to tenants. This would be long-term rentals, short-term rentals, or multifamily leasing. Number 8 is operation, day-to-day involvement in running real estate, handling utilities, overseeing maintenance, managing expenses, or coordinating vendors. Number 9 is management. This would be direct involvement in overseeing rental activities and decision-making. For example, tenant screening, setting rents, approving repairs, and supervising property managers. Number 10, leasing. This would be activities related specifically to securing or renewing tenants. For example, advertising units, showing properties, and negotiating lease terms. And then number 11 is a brokerage. This is acting as an intermediary in real estate transactions. This is real estate agents or brokers earning commissions from buying, selling, or leasing property. The hours from each of these can be grouped together to meet the 750-hour test, as long as you materially participate in them. Now, reps alone is not enough, and this is where people get tripped up. Reps does not eliminate the material participation requirement. It only removes the automatic passive label. To actually deduct losses, you must materially participate in each rental activity or a properly grouped set of rental activities. Material participation is measured using IRS tests, like the 500-hour test, the 100-hour test, or the facts and circumstances test. No material participation means no deduction, even with reps. So here are a couple of scenarios that we can walk through assuming these requirements are met. Let's say you work more than 750 hours during the year in a real property trade or business. Now, if you also work as an Uber driver for 500 hours out of the year, then you do qualify for real estate professional status. On the other hand, if you have a full-time job working 2,000 hours per year, and you also spend 750 hours working in real estate property, trade, or business, then you do not qualify. For the next scenario, let's say you have a full-time job working over 2,000 hours a year, but your spouse is unemployed. You could not qualify as a real estate professional status, but your spouse could be if those 750 hours were more than anything else she did. So she could not have a W-2 job that is over 750 hours. Why reps makes bonus depreciation so powerful? Cost segregation accelerates depreciation by breaking out the property into faster depreciating components. Bonus depreciation lets you deduct a large portion of those components up front. With reps and material participation, those same depreciation losses become non-passive and can offset W-2 income, business income, or other active income. This is how you see high-income earners legally wiping out six-figure tax bills just by using real estate. Miss any one of those steps and the strategy breaks. Remember, documentation is not negotiable. The IRS does not take your word for it. To defend reps, you must maintain contemporaneous time logs, calendars or appointment records, description of work performed, and supporting emails, invoices, or contacts. Reps is not for everyone. It's not a checkbox, and it's definitely not something you decide after the year is over. But when planned correctly, reps is the keystone strategy that allows depreciation to actually reduce real-world taxes. If you haven't already, I strongly recommend you watch my prior videos on bonus depreciation, cost segregation, material participation, and passive versus non-passive income. Because reps only works when all four concepts are understood and applied together. Many CPAs don't understand all of the rules and how to plan to take advantage of those rules in order to save you thousands of dollars in taxes. Or they just think it's too complicated and they don't want to deal with it. If you think you can qualify and would like more help on determining how this can work for you, click the link in the description below and let's get you started on your zero tax blueprint.